Margaret worked as a hospital administrator in Nashville for 31 years. She was organized, she was careful with money, she kept records. She retired at 64 after a long career managing departments, budgets, and 3 different hospital wings. She knew retirement was going to require adjustments, but she had planned for it. She had a traditional IRA, a small pension, and Social Security coming in every month. She had modeled her income carefully. She knew what she expected to pay. And then her first Medicare bill arrived. It was $284.10 per month. Not the $202.90 she had budgeted for. Not the standard rate that most retirees pay. The higher rate, the IRMAA rate, the surcharge. And here is the part that almost broke her. She had already retired. Her income had already dropped dramatically. She was no longer earning what she earned in 2024. She was living on a fraction of that income. But Medicare did not care what her income was today. Medicare looked back 2 years, pulled her 2024 tax return, saw the salary she was earning before she retired, and charged her accordingly, every single month, for a full calendar year. Margaret called Medicare. They confirmed the number. She called Social Security. They told her there was a form she could file, a form that, if submitted correctly with the right documentation, could reduce her Medicare premium once SSA approved the new determination, based on what her income actually was now, not what it was 2 years ago. Nobody had told her about that form before she retired. Not her HR department, not her financial advisor, not the Medicare welcome packet she received in the mail. That form is SSA-44. And if your income dropped after you retired, and you are currently paying more than $202.90 per month for Medicare Part B, that form may be worth thousands of dollars to you. Not in theory, in your actual bank account. This video is for educational purposes only, and is not tax or financial advice. Please consult a qualified tax professional or elder law specialist before making any decisions about your specific situation. My name is Kevin, and this is Kevin Ritchie Strategy. Every week, I break down the tax rules, the government forms, and the income protection moves that most retirees never hear about until it is too late. If that sounds like exactly what you need, subscribe right now and turn on the bell, because the information I am about to walk you through is completely public, completely documented by the Social Security Administration and the Centers for Medicare and Medicaid Services, and almost completely unknown to the retirees it would help the most. Let me start with the rule that creates this problem in the first place. Because until you understand exactly how Medicare premiums are calculated, you cannot fully appreciate why the fix is so powerful, or why the damage compounds in ways most people never connect. Medicare does not look at your current income to set your premium. It looks at your income from 2 years ago. That is confirmed directly by the Social Security Administration. For 2026, the Social Security Administration uses the most recent federal tax return the IRS has provided, and for 2026, that is generally the return filed in 2025 covering tax year 2024. So right now, in 2026, what showed up on your 2024 tax return is determining what you pay for Medicare today. Not what you earned last month, not what you are earning now, what you earned 2 years ago. For most working Americans, this is a non-issue. Income is relatively stable year over year. But for retirees, this 2-year look-back creates a very specific and very expensive trap, because retirement does not happen gradually. It happens on a date. One day you have a full salary hitting your account. The next day you do not. But Medicare does not adjust to that date. It keeps charging based on the income you had before that date, and it keeps charging at that rate for up to 2 full years unless you act. Now let me show you exactly what this costs in dollar terms, because I want you to see the real number before we talk about how to recover it. The standard Medicare Part B premium in 2026, according to the Centers for Medicare and Medicaid Services, is $202.90 per month. That is what most retirees pay. That is the baseline. But IRMA, the income-related monthly adjustment amount, is a surcharge that gets layered on top of the standard premium when your modified adjusted gross income exceeds certain thresholds based on that 2-year-old tax return. Here is exactly how the tiers work in 2026 based on the official CMS premium tables. If you are a single filer and your modified adjusted gross income from 2024 was above $109,000, you are no longer paying the standard rate. You are in the first IRMA tier. Your Part B premium at that tier is $284.10 per month. That is $81.20 more per month than the standard rate. Across 12 months, that is $974.40 more per year, just for being above that line, just based on income from 2 years ago. And that is the first tier. The tiers go significantly higher from there. At the second tier, the premium climbs further. At the highest income tier for 2026, the Part B premium reaches $628.90 per month. Not a typo. That is more than 3 times the standard rate. And remember, IRMA is not just Part B. Medicare Part D, your prescription drug coverage, also carries its own IRMA surcharge. According to CMS, the Part D surcharge at the first tier starts at $14.50 per month, on top of whatever your plan premium already is. Wait, I need to correct something I said. The top tier number. Let me be precise with you, because precision is what matters in this lane. According to the CMS 2026 Part B premium table, the highest full Part B premium in 2026 is $628.90 per month. That is for those at the top IRMA income tier. The number is real and it is large. For married couples filing jointly, the first IRMA threshold for 2026 starts above $218,000 in modified adjusted gross income. If your combined household income in 2024 exceeded that number, both of you are being charged the surcharge. Both, separately, every single month. Now let me show you the math that makes this feel real, because I want you to understand what is actually sitting on the table here. A retired couple where both spouses are enrolled in Medicare and both are in the first IRMA tier is paying $81.20 extra per month each. That is $162.40 extra per month for the household. That is $1,948.80 extra per year. That is in addition to their plan premiums. That is before Part D surcharges are added for either spouse. And here is the compounding problem with IRMA that almost nobody explains before you retire. The decision that created the surcharge happened 2 years ago, but the surcharge runs for a full 12 months once it is set. You are paying a full year penalty for an income year that is already in the past and may no longer reflect your life at all. But here is where the cost gets dangerous in a way the monthly number does not fully capture. IRMA does not work in isolation. It interacts with 3 other financial systems that most retirees have never seen explained together. The first interaction is with your IRA distributions. If you are taking money from a traditional IRA in retirement, and most retirees with meaningful savings are, every dollar of that distribution is ordinary income. It goes straight into your modified adjusted gross income, that same MAGI number the SSA uses to set your IRMA tier. So a retiree who takes a large IRA distribution in 2026 is not just paying income tax on that withdrawal today. That distribution can push their 2028 Medicare premium into a higher IRMA tier 2 years from now on a decision made today. 1 action, 2 tax events separated by 2 calendar years. The second interaction is with Social Security taxation. The IRS calculates what they call combined income for Social Security purposes as your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. For single filers, once combined income exceeds $34,000, up to 85% of your Social Security benefit becomes federally taxable ordinary income. IRMA surcharges do not make your Social Security more taxable directly, but the same IRA distributions that push you into an IRMA tier also push more of your Social Security into the taxable range simultaneously. One large IRMA distribution triggers IRMA in year 2 and triggers Social Security taxation in the same year. You pay twice on one decision, from 2 different directions. The third interaction is the one that is hardest to see until it happens. When a spouse dies, the surviving spouse must file taxes as a single filer starting the year after the death. That filing status change cuts the IRMA threshold roughly in half. A single filer's first threshold is $109,000. A joint filer's first threshold is $218,000. A surviving spouse who had joint income of $190,000, which was comfortably below the joint threshold, suddenly has that same income measured against the $109,000 single threshold. The premium surcharge can jump immediately, not because income changed, because the filing status changed. The surcharge applies to the surviving spouse for the full year, at the new rate, on income that did not change at all. That is 3 ways the IRMA problem compounds beyond the simple monthly surcharge. The monthly number is the visible part. The downstream tax interactions, the IRA ripple effect, and the survivor exposure are the parts that retirees pay for without ever seeing them connected on a single page. Now let me show you the fix, because a problem this layered deserves a solution that is explained just as precisely. The Social Security Administration has a provision specifically designed for retirees who are being charged based on income that no longer reflects their current situation. It is not hidden. It is documented publicly on the SSA website. It is called a life-changing event appeal, and it allows you to request a new IRMA determination based on your current estimated income rather than your 2-year-old tax return. Once SSA reviews and approves the new determination, your premium is adjusted. The SSA has a specific official list of qualifying life-changing events. These are the situations that allow you to trigger this appeal. The list includes marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property, loss or reduction of pension income, and receipt of certain employer settlements. That is the official list directly from the Social Security Administration. And right there on that list is the event that applies to almost every retiree watching this video. Work stoppage. Retirement. When you retired, your work stopped. That is a qualifying life-changing event under SSA's own rules. That means if you retired and your income dropped, you have grounds to ask the Social Security Administration to use your current lower income instead of your 2024 income to determine your 2026 Medicare premium. And the form you file to trigger that process is SSA-44. The full name is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, SSA-44. You can complete it online. You can upload it through your My Social Security account. You can mail it to your local SSA office. You can fax it. The Social Security Administration accepts all of those submission methods. The form exists. The process is real. The appeal pathway is official. Now let me walk you through exactly what happens when you file SSA-44, because I want you to understand what you are submitting and what the SSA does with it. When you complete SSA-44, you are telling the Social Security Administration 2 things. First, that a specific qualifying life-changing event occurred, in most cases your retirement, which caused your household income to decrease. Second, that your estimated modified adjusted gross income for the current year is lower than the income on the 2024 tax return the SSA is currently using to calculate your premium. You provide your best honest estimate of your current year income. You provide documentation of the life-changing event. The SSA uses that information to recalculate your IRMA determination. If your estimated current income falls below the threshold for your filing status or into a lower tier than you are currently assigned, your premium is reduced once SSA approves the new determination. Let me be specific about what the SSA actually accepts as proof, because this is where a lot of people slow down unnecessarily. According to the Social Security Administration's own Policy Operations Manual, which is publicly available, when someone files for a new IRMAA determination based on work stoppage or work reduction, evidence can take several forms. You can provide a statement from your employer documenting your retirement date. You can provide a retirement letter. If you sold or transferred a business, you can provide a record of that sale or transfer. You can provide pay stubs showing that your hours or earnings were reduced. And the SSA's own guidance states that in some cases, a signed statement from you, the beneficiary, under penalty of perjury, confirming the work stoppage, can be accepted as documentation. The SSA also notes that amended return situations should be handled by contacting SSA directly rather than solely relying on the standard form submission. That last point matters. You do not need an elaborate documentation package in most cases. A retirement letter from your former employer, combined with your completed SSA-44 and your projected income estimate for the current year, is typically what starts the process for a retirement-based appeal. If you have not kept your retirement letter, most HR departments can reproduce one on request in a matter of days. Now let me show you the income estimate piece, because this is the number that actually drives the outcome of your appeal. The income estimate you provide on SSA-44 is your projected modified adjusted gross income for the current calendar year. This is not a rough guess. This is a real calculation. It includes wages, if you have any, pension income, Social Security benefits, taxable IRA distributions, capital gains, taxable interest, and any other income that flows into your adjusted gross income. It does not include qualified Roth IRA withdrawals. Roth withdrawals do not count toward your MAGI. This is one of the most valuable features of Roth assets in retirement, and it is especially relevant here because a retiree who has shifted a portion of their savings into Roth accounts during their working years has a tool to manage their MAGI in retirement that a retiree with only traditional accounts does not. A retiree living primarily on Social Security and a modest pension, taking Roth distributions to supplement their income instead of traditional IRA distributions, may have a MAGI significantly lower than their total household spending. That lower MAGI is what goes on SSA-44, and that lower MAGI is what the SSA uses to set the new premium. Let me make this concrete with real numbers, because I want you to see this on paper before you look at your own situation. Daniel worked as a project manager for a manufacturing company in Ohio for 28 years. In 2024, his last full year of employment, he earned $131,000 in total compensation, including his bonus. He retired in February of 2025. For 2026, the SSA pulled his 2024 tax return, saw $131,000 in income, and placed him in the first IRMAA tier. His Part B premium is $284.10 per month. His Part D surcharge is $14.50 per month on top of his plan premium. He is paying over $3,500 per year in Medicare premiums. In 2026, after his February 2025 retirement, Daniel's income consists of a pension of $19,200 per year and Social Security of $26,400 per year. He has not yet begun taking IRA distributions. His total modified adjusted gross income in 2026 is approximately $45,600. No wages, no distributions. His income is dramatically lower than the $131,000 the SSA used to set his premium. At $45,600 in modified adjusted gross income as a single filer, Daniel is not just below the first IRMAA tier, he is well below it. The first tier starts at $109,000. Daniel should be paying $202.90 per month, not $284.10. The difference is $81.20 per month. Over a full year, that is $974.40, plus the Part D surcharge he should not be paying at all. Daniel files SSA-44 with his retirement letter from his employer and his income projection for 2026. The SSA reviews his documentation and issues a new IRMAA determination. His Part B premium is reduced to $202.90. His Part D surcharge is removed. He receives an adjustment for the months he had already paid the higher rate. The total recovery for the year is over $1,100 when both the Part B and Part D corrections are combined. That is what SSA-44 does when it is filed correctly and the income gap is real. And for most retirees who retired in 2024 or 2025 and had pre-retirement income above the IRMAA threshold, that income gap is very real. Now I want to walk through the specific IRMAA traps that catch retirees even when they think they have planned correctly, because this is where the money gets lost in the years after the initial retirement transition. The first trap is the large one-time income event. A retiree who retired in 2025 but took a large IRA distribution in 2024 to pay off a mortgage, to fund a renovation, to cover a medical expense, or to help a child with a down payment may find that the 2024 distribution pushed their magi above the IRMAA threshold for 2026, even though their ongoing retirement income is modest. The distribution was a one-time event. It will not repeat. But IRMAA does not know that. It sees the 2024 tax return, sees the spike in income, and sets the premium accordingly for a full year. SSA-44 does not undo a prior year's income. What it does is allow you to use your current, lower, non-spiked income as the basis for your determination going forward. If your 2026 income genuinely reflects your normal retirement baseline, SSA-44 applies that baseline to your premium. The second trap is the one that catches married couples at the worst possible moment, the year after a spouse dies. I mentioned this earlier in the consequence stack, but I want to go deeper here because the financial damage in this situation is compounded by grief and transition, and most families are completely unprepared for it. When one spouse passes away, the survivor files as a single filer, starting the following tax year. That cuts the joint IRMAA threshold of $218,000 down to the single threshold of $109,000. The surviving spouse may have the same income they had the year before, a pension, Social Security, IRA distributions. The total household income may have actually decreased because one Social Security stopped. But the IRMAA threshold that their income is measured against has been cut in half. A surviving spouse who had combined household income of $175,000 on a joint return, safely below the $218,000 joint threshold, may now find their individual income of $88,000 still below the single threshold of $109,000. In that case, no IRMAA applies. But if their income was $120,000 on a joint return and their share is $95,000 after the death, they are now above the single threshold of $109,000, and they are paying an IRMAA surcharge they were not paying before on lower income than before because the filing status changed. In this specific case, the death of a spouse is a qualifying life-changing event for SSA-44. The surviving spouse can file SSA-44 to request a new IRMAA determination based on their current projected income as a single filer. That appeal can potentially reduce or eliminate the surcharge that the filing status change triggered. And the SSA Form SSA-44 also notes that amended return situations should be handled by contacting SSA directly. If your circumstances involve a prior year amended return or a complex income situation, the direct contact route is the one the SSA itself recommends. The third trap is the RMD cliff. Required minimum distributions begin at age 73 for most retirees under current law. At that point, the IRS requires you to withdraw a minimum amount from your traditional IRA every year, whether you need the income or not. The RMD amount is calculated by dividing your prior year-end account balance by an IRS life expectancy factor. At age 73, that factor is 26.5. So a retiree with $500,000 in their traditional IRA faces a first-year RMD of approximately $18,868. That RMD is fully taxable ordinary income. It goes straight into MAGI. And as the account balance grows or holds steady and the life expectancy factor shrinks each year, the RMD grows. At age 80, the factor drops to 20.2. The same $500,000 account now generates a forced distribution of nearly $24,000. For a retiree whose pension plus Social Security already puts their MAGI close to the IRMAA threshold, a growing RMD can push them over the line in a year when they did not expect it. And because IRMAA uses a 2-year look-back, an RMD that crosses the threshold in 2026 creates an IRMAA surcharge in 2028. The retiree does not feel the Medicare cost of their 2026 RMD until 2 years later. By then, many do not connect the two events. This is why the years between retirement and age 73, those gap years when income is lower and RMDs have not yet begun, are so critical for IRA management. Roth conversions during those gap years reduce the traditional IRA balance that will eventually be forced out as taxable RMDs. Every dollar converted during the gap years at lower tax rates is a dollar that does not appear in future MAGI calculations. It is a dollar that does not push Social Security into the taxable range. It is a dollar that does not trigger a future IRMAA surcharge. The retiree who actively manages their IRA balance during the gap years through strategic Roth conversions is not just doing tax planning. They are doing Medicare premium planning at the same time, for years and sometimes decades down the road. Now, let me give you the action checklist, because the steps I am about to walk through are exactly what Margaret did, what Daniel did, and what every retiree in this situation should do as soon as this video ends. Step 1. Log in to ssa.gov and access your My Social Security account. If you do not have one, create one. It takes approximately 10 minutes. Once you are logged in, look for your IRMAA determination letter. If you are enrolled in Medicare and you are paying more than the standard $202.90 per month for Part B, you received an IRMAA determination notice from SSA. That notice tells you the specific income figure SSA used to calculate your surcharge, what IRMAA tier you were placed in, and your right to appeal. Step 2. Compare the income on your IRMAA determination letter to your actual 2026 income projection. Your 2026 income projection includes all sources of taxable income you expect to receive this year: wages, if any, pension, Social Security, taxable IRA distributions, capital gains, taxable interest. Do not include Roth withdrawals. If your projected 2026 MAGI is substantially lower than the income on your determination letter, and if that lower income would move you below a threshold or into a lower tier, you have grounds for an SSA-44 appeal. Step 3. Gather your documentation. Match your documentation to the specific qualifying life-changing event that applies to your situation. If you retired, get your retirement letter from your employer or HR department. If a pension was reduced, get documentation from your pension administrator. If a spouse passed away, the death certificate is required. The SSA needs to verify both that the qualifying event occurred and that it caused the income reduction you were claiming. Step 4. Download and complete SSA-44. The form is available directly on the SSA Forms page. It is fillable online. You will provide your name, your Medicare claim number or Social Security number, the specific qualifying life-changing event, the year the event occurred, and your estimated modified adjusted gross income for the current year. Be precise about your income estimate, calculated from actual income sources, not a rough approximation. Step 5. Submit the form. You can upload it through your My Social Security online account. You can mail it to your local SSA office. You can fax it. Keep a copy of everything you submit, regardless of the method. If you mail or fax, document the date you sent it. Step 6. Follow up. The SSA will review your documentation and issue a new IRMAA determination. Processing times vary. If you have not received a response within 30 days of submission, follow up directly with the SSA. Once the new determination is issued, your Medicare premium is adjusted based on the new IRMAA calculation going forward from the date of the determination. Step 7. Plan the following year now, not later. SSA-44 addresses the current determination period, but the 2-year look-back continues permanently. A large IRA distribution you take in 2026 can affect your 2028 Medicare premium. A Roth conversion that pushes your 2026 MAGI above an IRMAA threshold creates a 2028 surcharge. Managing your annual MAGI with the IRMAA thresholds in mind, not just your income tax bracket, is an ongoing planning responsibility, not a one-time fix. Now I want to address the objections I hear from retirees when they first learn about this process, because I want to be straight with you about what SSA-44 is and what it is not. The first objection. My income dropped, but I am not sure it dropped enough to move me below a threshold or into a lower tier. Is it worth filing? Yes. Filing SSA-44 does not guarantee a premium reduction. It guarantees a review. If your income estimate still places you in the same tier you are currently in, your premium will not change from the form, but it will not increase either. And if your income estimate places you in a lower tier or below the threshold entirely, you benefit from the reduction once the determination is approved. The worst possible outcome from filing SSA-44 when you are eligible is no change. There is no penalty for submitting a form that results in no tier movement. The second objection. What if I estimate my income and it turns out to be higher than what I reported? Take this seriously. SSA-44 is submitted under penalty of perjury. Your estimate should be your honest, calculated projection, not your most optimistic scenario. Once your actual 2026 tax return is filed and the IRS provides that data to the SSA will use it to set your 2028 IRMAA. If your actual income ended up higher than your estimate, the 2028 determination will reflect that. You will not face a retroactive penalty for an honest estimate that turned out to be low. But deliberate misrepresentation on a federal form is a different matter entirely, and that is not what this channel is ever going to advise. The practical guidance is this. Calculate. Do not guess. Include everything that belongs in MAGI. Leave out what does not belong, including Roth withdrawals. If your income could land in a range, estimate honestly from the middle of that range, not the floor. Let me come back to Margaret from Nashville, because I want to close her story the right way. Margaret filed SSA-44 4 months into her retirement. She provided her retirement letter from the hospital administration office, her Social Security award letter showing her monthly benefit amount, and her income estimate for the year, which was her pension income and her Social Security, and nothing else. She had no IRA distributions planned for the year. Her projected MAGI was well below the $109,000 single filer IRMAA threshold. The SSA reviewed her documentation and issued a new determination. Her Part B premium was reduced to the standard rate of $202.90. She received an adjustment for the months she had already paid the higher amount. She told me later that what stuck with her was not just the money recovered, although $974 is real money in retirement. It was the realization that the Social Security Administration had specifically built this process for people in exactly her situation, that the form existed, that the qualifying events were officially listed, that work stoppage, which is what retirement is, was explicitly on the list, and that nobody in the system that sent her the bill ever mentioned the form that could reduce it. The information was public, the form was real, the process was designed for her. It took 4 months and someone who knew where to look before she found out it existed. That is why this channel exists. Not to teach you secrets, to make sure you actually know the public information that the system never volunteers to explain. The retirees who know about SSA-44 file it when they qualify and stop paying the surcharge once SSA approves their new determination. The retirees who do not know about it pay the full surcharge for 2 full years until their actual income shows up on a more recent tax return and the SSA updates their determination automatically. The dollar difference between those two outcomes is real. The only difference between those two groups of retirees is whether they had the information in time to act. If this video gave you that information, do something with it today. Log in to SSA.gov. Pull your IRMAA determination letter if you have one. Compare the income on that letter to what your 2026 income actually looks like. If the gap is large enough to move you below a threshold or into a lower tier, download SSA-44 and start the process. And if you are not yet on Medicare but plan to be within the next few years, the most important thing you can do right now is model your projected MAGI for the 2-year look-back window. Understand which tax years the SSA will use to set your premium when you enroll. Plan your IRA distributions and any Roth conversions with those look-back years in mind. The IRMAA threshold is not a wall that appears without warning. It is a line on a map. If you know where it is and you know what income counts toward it, you can plan around it, and sometimes plan well under it. This is Kevin Rittrie's strategy. If this video showed you a government form and a process that you had not heard of before today, hit the like button right now and share this with anyone you know who retired in the last 2 years and may be paying a Medicare premium they do not have to pay. Subscribe and turn on the bell so you do not miss the next video. Tell me in the comments exactly where you are right now. Are you already on Medicare? Have you received an IRMAA surcharge notice? Did you know SSA-44 existed before watching this? Drop your situation in the comments. I read every single one. The most specific real-world situations from this audience become the topics of future videos on this channel. This is Kevin Rittrie's strategy.